Inflation, inflation, inflation. Gas is expensive, used cars cost the same as new cars, and home prices are going through the roof. What's going on? Well, starting in 2019, the Federal Reserve initiates the lowering of interest rates. Soon after, we're hit with COVID, which causes the supply chain backup, and eventually the federal government responds with COVID relief. Soon after that, the federal government passes a $1.9 trillion fiscal package. Well, this floods the market with money. And there's so much money out on the streets that the economy just can't keep up with that demand for those goods and services that everybody's requesting. Basically, this puts us in a state of inflation. So to combat inflation, the Federal Reserve must raise interest rates. And what that does is that makes mortgages more expensive. That makes auto loans more expensive. That makes credit card spending more expensive. Basically, anytime you're borrowing money, the cost of the money is just more expensive. And as that becomes more expensive, consumers are likely to not spend as much money. And if they're not spending any money, then they're not buying products. Therefore, the demand for these products falls. As the demand for the products falls, suppliers, to make a sale, they have to drop their prices. And basically that pulls us out of this inflation, the dropping of the prices. And whether we're in a state of inflation, deflation, recession, and economic boom, you still have some real estate financing and transactions that must go on, regardless if the world is crumbling around us. My name is Josué López. I am the broker at Grow Mortgages. And in this video, I will present to you 5 mortgage products that will help you in this inflationary market and help lessen the cost of financing. Okay, so the first product is a 10-year ARM. Now, this is a 30-year mortgage, but it's only fixed for the first 10 years. Then after that, it'll adjust based on the market. With this product, you can obtain a below market interest rate, usually of about 0.625%. And this creates for a lower payment for the borrower than what's currently being offered in the market. The next product is a 2-1 Buydown. This mortgage product lowers the interest rate for the first 2 years. So the mortgage on the first year starts off 2 percentage points lower. On the second year, it floats up 1 percentage point. And on the third through final years of the mortgage, it rises up 1%, but it stays fixed. Interest-only loans. On an interest-only loan, we exclude the principal portion from the payment. Therefore, it's lower than your typical amortized principal and interest payments. You can still lower the principal balance by paying more than the required interest-only payment. However, you're not obligated to do so. HELOCs, a home equity line of credit. With a HELOC, it allows you to keep your low first mortgage interest rate in place without disturbing that low payment. But now it allows you to tap into that equity in your property for the use of consolidation for bills at a lower interest rate than credit cards, or for investment purposes, such as to pull money out to create an ADU or to buy another property. So a HELOC is a great way to tap into your home's equity without disturbing your first mortgage. And lastly, we have 40-year term mortgages. Rather than your typical 30-year mortgage, this is a 40-year mortgage, which extends a little bit longer, an additional 10 years. Due to the extended term, this allows for lower payments in comparison to a 30-year mortgage. You can use the monthly savings for other expenses or for some type of investment. These 5 mortgage products should create a monthly savings or a positive cash flow, which will allow you to outwit this inflationary market. If you enjoyed this video, then please subscribe to our channel, share, and like. If you have any questions, please be sure to leave a comment so we can reach out to you. Thank you so much for your time.